What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time and where we think the management will treat us right. And we don't have to mark those down a lot when we find those factors.
Hey guys, welcome back to the channel. In this video, I take you through my checklist for finding wonderful high quality businesses using the teachings of Nick Sleep, Warren Buffett and Fred Liu. Over the last week, you guys have been voting on which business you want me to analyze using this checklist. So by popular demand, today we'll be looking at Tesla to see if it meets my requirements for being a wonderful high quality business. So before we get into it, it's worth mentioning that this checklist is only a part of my overall investing framework. Once I find a company that I understand and it's within my circle of competence, the first thing I do is put it through this checklist to see if it is a high quality business. And if it meets the criteria we'll be looking at today, then I'll really dig in and try to understand the business more deeply. Now, the checklist itself is 3 really important figures. And after I briefly explain them, I'll show you guys a new spreadsheet I made to track all 3 key figures over long periods of time. Okay, so the first key figure used to determine if a business is high quality, which is used by Warren Buffett, Nick Sleep, Charlie Munger and many others, is return on capital employed, or ROCE for short. Quite simply, the capital employed is all the capital being used within the business, and the return is how much cash a company generates using that capital. So essentially, it's the return that the company gets from investing capital in itself. Let's say we had a business with $100 in total capital employed, which you can find for any business by taking the total assets on the balance sheet and subtracting current liabilities. So total assets minus current liabilities equals total capital employed. Now for the return, we'll say the business generated $20 in free cash flow. So for the return, you can use net income, operating cash flow, free cash flow, or any sort of bottom line figure that's most relevant to the business you're looking at. So if we have $100 in total capital employed and the business generated $20 of free cash flow, then the return on capital employed is 20%, which is really, really good. So that's step 1. The next step is we need to determine the company's return on incremental capital employed. This sounds way more complicated than it is, so just allow me to show you using our example from before. So let's say a year has passed for our business and its capital employed is now $120. So it increased its total capital by $20 since last year. That $20 is the incremental capital employed. So essentially, incremental capital just means new or additional capital that's been deployed by the business. It's the difference between the capital employed this year and last year. So now we want to see what return this new capital generates. Let's say in that year, our business generated $24 in free cash flow. So we can see the difference in cash flows between this year and last year is $4, which means that $20 of new incremental capital generated an additional $4 in new free cash flow, which works out to be a 20% return on incremental capital employed. So quite simply, the return on incremental capital is the return the business generates on its new additional capital. Both are equally as important because you want to understand if a business has a good history of generating high returns on capital employed. But you also want to see that they're still able to generate high returns on any new capital being employed by the business. Okay, so our final important figure is a really easy one to figure out. And thankfully it's already been uncovered in our example before, and that is the reinvestment rate. Essentially, the reinvestment rate is how much of the company's cash flows have been reinvested back into the business. Again, this is really simple to figure out. So first up, we simply take our cash flow from the most recent year, which was $24. So we want to know how much of that was reinvested back into the business. If we compare it to the incremental capital employed, or the new capital, we can figure out the reinvestment rate. So if we had $24 in free cash flow, and $20 was reinvested into new capital, that gives us a reinvestment rate of 83.3%, which is really good. The higher the reinvestment rate, the better, because it shows the business has loads of opportunities to reinvest earnings and deploy new capital. And if it can keep achieving the same high returns on capital employed after deploying new capital, then you found a truly wonderful business, or as it's also called, a long-term compounder. So that's really the secret sauce of a high quality business. A high return on capital employed, plus a high return on incremental capital employed, plus a high reinvestment rate equals long-term compounder, aka high quality business. A high quality compounder can compound its intrinsic value year after year after year, and it can generate really substantial returns over long periods of time. This strategy is how Warren Buffett made his fortune, by investing in Coca-Cola and See's Candy. It's how Nick Sleep made his fortune by investing in Amazon, and it's how Charlie Munger made his fortune by investing in Berkshire and Costco. And many other super investors I follow like Fred Liu use this strategy as well. Alright, let's use this checklist on my biggest holding, Tesla. And we'll be using two really simple spreadsheets that make it really clear and easy to track. Both of these will be available to download for free if you're interested in using them. So this is the first part of the spreadsheet that's used to calculate the return on capital employed. And it's already filled out with Tesla's numbers. With Tesla, the figure I'm using for the return is operating cash flow. I've touched on this in past videos, but for capital intensive growing businesses, I prefer to use operating cash flow over free cash flow, because I think it represents the true earnings power of the business if it wasn't spending on growth, which is something I borrowed from Nick Sleep. As we can see with Tesla, their return on capital employed is a massive 25% and has been growing substantially year after year. So this shows Tesla is a quality business and we can move on to the next stage. Just to quickly show you how to use this yourself, let's fast forward to next year and punch in some imaginary numbers. So for the return, I'll put in 15 billion. For the total assets, I'll put 65 billion. For R&D, 3 billion. And for the current liabilities, I'll put 20 billion. So you have 65 plus 3 and minus 20 to give us 48 billion in total capital employed. Then the calculator divides the return by the total capital, which gives us a return on capital employed of 31%. Easy peasy, right? So now we can move on to the second spreadsheet, which is what we use to figure out the return on incremental capital and the reinvestment rate. Now it's pretty similar to the example we used earlier, but it's just a little more detailed. And the only numbers we need to do any inputs for are the grey boxes, and the calculator does the rest. On one side I usually have the 5-year numbers, and on the other side I have the 10-year numbers. But because Tesla was unprofitable 10 years ago, for now I'm using a 4-year model and a 1-year model. It doesn't really matter what time frames you use, but it's good to have at least one long-term time frame and one short-term time frame, so you can contrast the difference between the company's long-term and short-term reinvestment rate. So with Tesla, we'll focus on the left side first. First up we have our return, and this time I am using free cash flow. Using operating cash flow doesn't really work in this one, as some of it is already allocated to growth spending through CapEx. So using free cash flow works better here. Now we have their cash flow for 2018 and 2021, as well as the difference. Then we have our total assets plus R&D, and then minus our current liabilities to give us our total capital employed. So in order to get the reinvestment rate over a longer time period, we need our cumulative cash flows over the last 3 years. The reason it's 3 years is because we're doing a 4-year model starting at 2018. And so we start counting from the 2019 cash flows. So to get 8667, I added up these last 3 free cash flow amounts from QuickFS. The final number we need to complete this side is the incremental capital employed, which is pretty easy because it's right here. Remember, incremental capital is the new capital that's been deployed by the business. So since 2018, when they had 21 billion in capital employed, they've since added another 23.8 billion to get a total of 45 billion in 2021. So we simply put that in the box for the incremental capital. Now the calculator's done its thing and the results are incredible for Tesla. Since 2018, cumulatively they've made about 9 billion in free cash flow. But they've deployed over 23 billion of incremental capital, which gives them a staggering reinvestment rate of 274%. And yes, the reinvestment rate can be greater than 100%, which is amazing as there's obviously so many opportunities to deploy more incremental capital within the business, which should also generate high returns. And if we look at exactly that, we can see Tesla's return on incremental capital, or the return being generated on the new capital, is around 22%. Which puts it right in the wonderful category. Now there's one other number here that we haven't covered yet, something called the value compounding rate of the business. This is an idea I borrowed from Fred Liu at Hayden Capital and John Huber at Sabre Capital Management. John wrote on Sabre's website, basically the compounding effect is the product of 2 factors, the return on incremental capital and the reinvestment rate. If a business can achieve 20% returns on capital and it can reinvest 50% of its earnings each year, the intrinsic value of the business will compound by 10% annually, because 20% times 50% equals 10%. So to get the compounding rate of the business's intrinsic value, you simply multiply the return on incremental capital by the reinvestment rate. So if we go back to Tesla, our calculator has already multiplied the incremental capital by the reinvestment rate to give us a value compounding rate of 60%, which means over the last 4 years, Tesla's intrinsic value has compounded by 60% a year, which is absolutely incredible. Now we can move over to the 1 year and see how they've performed just over the last 12 months. So we can see they generated around 5 billion in free cash flow, and they deployed an additional 5.6 billion in incremental capital, which gives us a reinvestment rate of 112%. That 5.6 billion in incremental capital generated around 2.2 billion in additional cash flow, which gives us a return on incremental capital employed of over 40%, which is pretty crazy. And finally, the compounding rate of the business just in the last year was 45%. These are absolutely incredible results for Tesla, and it's pretty undeniable that they're a wonderful high quality business. This is probably one of the best ways I've seen to determine a company's quality. The return on capital, the return on incremental capital, and the reinvestment rate are the 3 pillars for discovering high quality compounders. And being able to keep track of them year after year to see if they're still generating high returns on new capital, or if they're starting to drop off, really helps a lot. Now, if a business passes these tests, I don't just immediately go out and buy it. There's a lot more questions I try to answer before I even try to value the business. Questions like, will they continuously have reinvestment opportunities like they have in the past? Will they be able to generate the same high returns on capital? How long is the runway for this business? So are they early in their life cycle or are they starting to decline? And what are the barriers to entry in this obviously lucrative business? If other people see that Tesla are generating these high returns on capital employed and have endless reinvestment opportunities, then other companies will try come take a piece of that business for themselves. So ask yourself, what does it take to compete with this business? And what are the barriers to entry? Let's say I wanted to start a business and compete with Tesla. Before I could even start, I'd have to spend tens of billions to build the factories and acquire the robots. Then I'd have to hire thousands of engineers. So Tesla have quite a strong barrier to entry. And other EV automakers like Rivian and Lucid are beginning to understand that it's not easy. So overall, the 3 pillars is probably the most important part of my research, but it's still only a small part of my overall investing framework. Obviously, with Tesla being my biggest holding, it's met all of my criteria. It has to be a business that I really understand, it has to have a durable moat, it has to have an exceptional management team, and the price has to be reasonable relative to its intrinsic value. So that's my main method for judging a business's quality. I really hope you found this tutorial style video useful and it helps you out with your own analysis. And I'll link the spreadsheets below for anyone that's interested. If you've enjoyed the video so far and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one or join our little community, then hit that subscribe button. And if you're still bored, I'll put another video up in the corner that I think you'll find interesting. If you've watched the video all the way to the end, thank you so much for watching. In the spirit of not wasting your time, I might have skipped over a few topics and not covered them enough. So if you have any questions about anything I said, please let me know in the comments below. If you're new to investing and you want to learn how I invest using the Buffett-Munger framework, or if you just want to download and use my intrinsic value spreadsheets, then check out the free course on the channel. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching and I'll see you guys in the next one.